Hello friends, welcome to this February edition of Monthly Viewpoints, wherein we will cover a few highlights of the FY23 budget and our outlook for markets. The Indian economy is still recovering from the COVID pandemic, and the need of the hour was a budget that would sustain the economy on the recovery path. In continuance with the previous budget, the government has announced a budget for FY23 that complements macro growth with social welfare while being accommodative on fiscal consolidation. With a clear focus on improving the quality of spending, the FY23 capex spend has been budgeted at INR 7.5 lakh crores, which is a year-over-year growth of 35%. The budget has reiterated the government's focus on public investment to modernize infrastructure over the medium term. Overall, increased investment is expected to have a multiply effect and should benefit companies in various sectors such as capital goods, cement, logistics, infrastructure, pipes, real estate, and so on. The budget also took forward the steps taken in last year's budget to stimulate domestic manufacturing by simplifying customs duty for sectors such as chemicals and electronics manufacturing. The government also continued its effort to support private sector growth and support new business models. One of the key highlights of the budget was its focus on the digital economy, startups, and tech-enabled development, as well as on energy transition and climate action. Overall, the budget receipt estimates, both on the tax and non-tax front, are reasonable and should be achievable. Budget 22-23 is pro-growth, conservative in its assumptions, and forward-looking. From the perspective of markets, we believe that the one-way risk-on rally that was driven by high liquidity and low interest rates in 2021 has eased since the beginning of this year. Rising geopolitical tensions in Ukraine also adding to the uncertainty. With inflation in the US now touching a 40-year high of 7.5%, the US Fed has increasingly taken a hawkish tone on inflation and is expected to now hike rates by 7 times in 2022. Consequently, the US 10-year bond yields have inched up to 2% levels. In this scenario, the terminal value of various new age technology companies, which are more sensitive to interest rates, may get impacted and should see some adjustment in the PE multiples. We are already witnessing some correction in few of these companies. From India's perspective, action by the US Fed may lead to short-term volatility. However, in the past bull markets, correction of more than 10% have been normal. Past episodes also point out that emerging markets have typically outperformed developed markets in 3 of the last 5 Fed rate hiking cycles. Moreover, we do not expect RBI to follow the Fed and aggressively raise rates, as the situation in India is different. Inflation in India is well under control, giving sufficient room for the RBI to maintain an accommodative policy for supporting growth. This was also reflected in the recent monetary policy meeting, which was more dovish than market expectations. Lastly, the Q3 FY22 results also point out that companies are largely delivering on the earnings front, despite the unprecedented inflationary pressures from rising commodity and energy prices. Given that earnings and GDP growth projections are anticipated to be strong going forward, it should neutralize the impact of rate hikes going ahead. On an overall basis, we continue to remain positive on the overall construct of Indian equity markets this year, but expect markets to be more discerning, wherein stocks will be driven more by fundamentals. We continue to remain positive on banking and financials, domestic cyclicals, and industrial sectors. We provide a basket of funds for investors to choose from. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।